Joining me right now is the former chairman of the FDIC. Sheila Bair is with us. Sheila, good to see you.
Thanks.
Thanks so much for joining us. So Wells Fargo trying to make amends. Tell me how you see it. What does it need to do right now to get people to have confidence and feel like, okay, they made a mistake, but they're moving beyond it?
Right. Well, I think they're still trying to recover from some initial missteps that were very serious. So I think what they're doing now is right. The board's doing an investigation. If there's additional accountability to be imposed, I assume that will come out as a result of the board's investigation. They're reaching out to consumers. They're proactively reaching out. They're providing resources for consumers who are concerned. So everything that can be done, it seems to me that they are doing, and they'll just need to ride it out. There's going to be a lot of pain, I think, before this is all over.
The whole idea of these aggressive sales targets, not just at Wells Fargo, sales targets, and this idea that you want to have a sticky business. You have one customer having a checking account. You want to sell them everything from a mortgage to a savings account to a debit card. Can we get around that? Will you expect an industry change as it results to these sales targets?
A positive result might be to review these kinds of sales goals and how they're interpreted and enforced by with employees. I think, you can do it the right way, but you should be looking at whether you're providing value added to your customers. So if it's something the customer wants, that the customer is actually using, that's improving benefits and reducing costs for customers, cross-selling isn't necessarily a bad thing, but the focus needs to be on customer benefit, not just numbers, driving up the number of accounts, because that leads to gaming and customer abuse, as we saw at Wells.
We talk a lot on this program about regulation, and whether or not the regulatory environment is really choking small business or even medium-sized business. What's your take on that in terms of, let's face it, the Wells Fargo situation was not caught by the Consumer Protection Bureau. The LA Times caught this.
Yes.
So it's not like, this regulatory environment where you have all of these agencies is necessarily making a difference.
Well, I think it is.
Or is it?
Well, I think it is. I think, I used to say at the FDIC, and I still say, examiners should be, when they scope an exam, they should be looking at press reports, they should be looking at analyst reports. And I think I know the reporter at the LA Times who broke this. He's a very, very good reporter. He did a lot of work during the subprime crisis as well. So, journalists can provide value added to the supervisory process. I don't necessarily think that's falling down by the regulators, but it's a resource regulators should use. But then they work very well with the OCC once they did get on top of it. And so I think it does show that there's value added with consumer protection. But you're right. It wasn't, the CFPB wasn't really a driver here. They responded, but they acted appropriately, I think, once it came to their attention.
So what do you want to see from the regulatory agencies as it applies to banks?
Yeah. Well, so I think common sense, even-handedness, simplicity, consistency with enforcement, I think those are the kinds of things that any regulated business needs in terms of being able to grow and profit in a responsible way under regulatory framework. But you do need transparency and consistency. And sometimes we get this, sometimes we don't.
Isn't it true that the whole idea of capital and how much capital to hold right now is still an issue that is keeping banks, keeping capital, holding it. Not investing it.
It's not, actually, capital is just a way to fund your balance sheet, so you're not really holding it. You can fund your balance sheet with equity, which is capital. You can fund your balance sheet with debt. If you fund your balance sheet with equity, then you have resilience, because that is loss absorbing. Debt holders, you have to pay them back. There's a legal obligation to pay. Equity holders, you don't.
But there are rules that these banks have to have so-called Tier 1 capital at certain levels. And they're not going to use that money for other things because they're going to just keep it there.
Actually, that was the point I was trying to make, is that, yes, they can use that equity capital to make loans. It's just a different way of funding themselves. And I do think, and regulators are at fault for talking about holding capital when it's really just a way you're funding your risk-taking activities. So capital is more expensive than debt, to the extent that it's more expensive to raise equity capital over debt. It might impair your ability to take risk on the margin, but that may be a good thing. But in a downturn, we want resilient banks. We want banks that can absorb losses when you get into a downturn. That's why you need extra cushions of capital in the good. So on that one, actually, I think the rules are too complex. I think they lend themselves to gaming, these risk-based rules, but the overall trend of increasing capital requirements for banks, I think, is a healthy one for the public.
What's the impact on the Deutsche Bank situation? It's facing more trouble. Deutsche Bank now say it's looking to shrink its U.S. operations in the face of these mounting legal expenses. We still don't know how much they owe the Department of Justice. First, it was $14 billion, and now they're talking about $6 billion. Could this situation ripple throughout the U.S. banking system?
I think it's certainly, there's been a long tail to this already, so I can only assume all the regulators are looking very closely at Deutsche Bank and coming up with contingency plans if things should get serious. They still have a lot of liquidity. There is a resolution mechanism now in Europe that they didn't have before that allows some government intervention so long as unsecured creditors as well as equity holders take losses first. So there are tools in the toolkit now that we didn't have prior to the crisis that I think give the German government the ability to handle that in an orderly way, working with other regulators if they have to. At this point, I don't see this happening. I think they're a very sick bank. I think they need to downsize. I think it's probably not realistic for them to go out and raise a lot of capital at anything that would be a reasonable cost. But downsizing, maybe selling their asset management business is probably what they need to do. And over time, they'll probably make them a more viable franchise if they simplify and get smaller.
So you don't think that this represents a potential impact to the broader financial system? I mean, back in 2007, a lot of people missed the fact that we're all interconnected. And, you know, if AIG goes down, Goldman Sachs gets impacted.
Right.
And if Lehman Brothers goes down, somebody else gets impacted. I mean, if Deutsche Bank is forced to sell its derivatives portfolio, for example, does that take more boats down with it?
I don't think so. If they sell the derivatives book, they might sell it to a stronger counterparty. So, you know, I don't know if that would be the case or not. I think, you know, canceling all those derivatives contracts would be disruptive. But again, we have tools in place now to maintain those derivative contractual relationships, even when you get into a resolution situation where the bank has actually failed. So is it interconnected? Yes. Could there be losses in other banks if they do fail and go into resolution? Yes. But that's exactly the kind of thing banks and regulators should be looking at right now. They should be looking at the exposure of major U.S. banks to Deutsche Bank and preparing for the worst. I don't think that's going to happen, but you always want to have contingency plans in place.
So from your standpoint, what should the regulatory framework look like? Donald Trump and Hillary Clinton obviously have been outlining their own plans to regulate the financial system. Trump says he wants a moratorium on financial regulations. Hillary Clinton says she wants to crack down on the banking system. How will this play out? What do you think is required?
Yeah, I think it's they're worlds apart, except for one thing, which is restoring Glass-Steagall, which is kind of interesting that they apparently both parties want to go back to separating commercial banking from investment banking. So that's something that's interesting to note. You know, I would just like simpler regulation, more transparent and more consistent regulation. Again, I think the key, the primary reform above all others, I do think, was to raise capital requirements to banks more resilient in a downturn. You look at a bank like Deutsche Bank. They had a lot of leverage, used a lot of short-term funding. That works fine. When the markets are going up, everything is good, you're making money. There's no capacity to absorb losses in a downturn. That's when you have to get into public support, which is what we want to avoid. So I do think simple, strong capital requirements are a good cornerstone of any regulatory system. Jeb Hensley actually proposed a bill along those lines. He wants to get rid of Dodd-Frank. I wouldn't go that far. I think there are many good things about Dodd-Frank, but I just point to that as a good conservative who I think has a principled approach based on capital for a resilient, stable financial system.